So I think everybody heard that. Good morning. I want to welcome you to the third in a series of 8 webinars that we're doing this winter. My name is Chris Cooper. I work at the Ohio Employee Ownership Center at Kent State University. This program that you're attending is sponsored and funded by the Ohio Department of Development, and it's part of a couple things, core missions that we do. One is the succession planning program for small business owners, and the second is the Ohio Employee Ownership Center part of what we do when we work with Ohio's employee-owned companies. The session today, we have Jim Steiker of SES Advisors out of Philadelphia. Jim's actually in Chicago this morning, joining us remotely. Today's session is employee sustainability. Will your ESOP last forever? And the key is to, when you're talking about employee ownership, just because generally speaking, when a company becomes employee-owned, it's part of a succession planning process, but that doesn't mean that the succession planning process is finished for an employee-owned company. Eventually, they're going to have to start thinking what's going to happen when that business starts moving on. So before I turn it over to Jim, one of the things I wanted to let everyone know that you can all ask a question by using the chat feature, which is on the lower left-hand pane of your screen, and also you can click the raise your hand button, and that will let us know that you all have a question that you'd want to ask the speaker. So I think without further ado, I'm going to go ahead and turn it over to Jim.
Thanks, Chris. I'm going to try and talk about, I guess, in the next almost hour is essentially what is the concept of sustainability, what does it mean, and what are the things that one can do to essentially encourage or enhance the chances that a company will continue to be employee-owned for the long term. And so we'll talk a little bit about what is sustainability, what's a working definition, why do we care about it, what do we think are some of the key factors that work in favor or against it, and what are some of the proactive things that folks can do. And I'm going to really encourage people to jump in with questions or comments. This is a kind of a rich topic and one that really would reward some greater input. As Chris mentioned, I'm from SES Advisors, also Steiker, Fisher, Edwards, and Greenapple in Philadelphia. And we work primarily with employee-owned companies. We do a mixture of law and finance and ESOP record keeping. And so one of the things we've done is tried to look at this from a bunch of different angles, and hopefully you'll see that reflected a little bit in the discussion today, because I think it is a multidisciplinary question. It's not clear, who in particular it is that you pick up and call, your lawyer, your record keeper, or so forth when you want to talk about sustainability. And one of the things that we see is that there's a good number of ESOP companies that take on a real identity, if you will, as employee-owned companies, that they really see themselves as that being key to who they are, and there's sort of an implied idea that they ought to be employee-owned forever. And that seems like a nice, easy concept, and certainly the day after one has done a transaction for a significant amount of company stock, I suspect on behalf of all of our clients, they probably don't really ever want to do it again. They really would like to feel like they are done. We dealt with succession, did that, and now we've done it. But obviously, the world keeps on moving and changing, and the notion of sustainability is really the idea of how do we keep being an employee-owned company. And most of the companies that we're talking about are companies that are 100% employee-owned. We obviously have, at this point, a lot of our clients are 100% ESOP-owned S corporations, taking advantage of the ability to operate tax-free, or at least have a very high percentage of ESOP ownership. And what we see is we see a bunch of impediments. We see, when we look at it and we say, why did companies get sold? Why did they not succeed? Why are they no longer employee-owned, including some companies that really seem to be very strongly committed to it? We see a bunch of impediments or causes to that, some of which are unavoidable and sort of the way of the world. Certainly adverse business conditions. We've had a bunch of clients that have been in various parts of real estate development, and those folks have all struggled in the last few years, and sad to say, but a few of them aren't around anymore, or were sold in highly distressed sales. And secondly, you have, certainly in the industrial sector, we've had the experience over the last, really the last 50 years, but at least 20 years in my experience of competition coming from different geographies. Today it's China. 20 years ago it was Japan. 30 years ago it was North Carolina. But what you have is the idea that when there's a high labor component to the product, people go looking for cheaper labor, and it remains hard to compete for an employee-owned company where the jobs are rooted in a particular cost structure in a particular place. It's a challenge to compete with new low-cost environments. And again, these are one of the things you can do some proactive business planning around, but it doesn't really relate. It's not an employee ownership problem. It's a business and change in the world economy problem. Third problem we have is sort of almost the opposite problem, which is there are companies that become very, very valuable. They all of a sudden have a very high strategic value to a non-employee-owned buyer. And so you have companies where you have a lot of employee ownership. The company's done very well, but it is now more valuable to somebody else than it is to the employee owners who operate it. And so there's a sort of competition between the value of remaining employee-owned and the big dollars that, if you will, are dangling out there from a third-party strategic buyer who says, you are what we want to be. And, a great example of this was a while ago, and a client I had that, was involved in dissemination of engineering abstracts in the early and mid-'90s, and of course that developed into an internet and electronic product. And the employee, and all of a sudden, one of the major publishers was willing to pay, what was literally about 40 times earnings and some multiple of revenues, and that of course, proved very hard to turn down. So these are things that are, things that happen. You can embed some things to make it harder to sell a company. Then you have companies that have very high capital investment requirements. They're successful, but in order to keep going, they need a lot of investment in cash to operate. And as we know, employee owners tend not to be deep-pocketed investors, and so there's always the challenge of how to raise sufficient capital. And then we get into the very much ESOP and employee-owned specific impediments, which is repurchase obligations in particular, which is how are we going to provide liquidity for the new generation of owners, which are the employee owners, particularly when we have demographic bubbles, meaning we got a lot of people close to the same age and planning to retire at the same time, or we have or we have planned provisions that require a lot of cash to go out fast for repurchase obligations. And finally, you get the sort of desire, particularly of key management, to say, gee, we want diversification, we want a liquidity event, we want to cash out, and it's easier to take other people's money rather than figure out how to do it internally. So these are some of the things we're going to talk about as impediments and some issues that come up and some planning that we can do around them. And, oops, I have this one twice here. But anyway, I'm going to use as a working definition this morning for sustainability is the idea of how do we maximize the opportunity for an employee-owned company to remain employee-owned for the benefit of current and future employees. That's my working definition of sustainability. And it doesn't presume that we can succeed 100% of the time, but it does presume that there are things that we can do that will make it more likely rather than less likely that a company will continue to be employee-owned for the long term. So the first question is, why do we care about this? Does it matter that a company be employee-owned forever? And from the viewpoint of the employee ownership advocates, professionals, and so forth, this has been a debate for a little while. There are folks who think employee ownership is great, and if employees have good liquidity events like owners did, the goal is not to be employee-owned forever. The goal is to spread wealth, and one way to spread wealth is for companies to have liquidity events. And of course, there's been a large number of folks who said employee-owned companies are really different. There's a bunch of intangible values that go with this, and this is a good thing in the long run. and we want to preserve it for the benefit of, we are stewards as well as investors, if you will, as employee owners. And if you look at the company side, the answer about sustainability is some companies don't care about sustainability. They really are viewing employee ownership primarily as a financial structure and perhaps a bit of an organization, a cultural structure. And they really do have an investment mindset on behalf of, if they're management on behalf of employees or employees, they say, we're going to have our turn at bat and we're going to cash out and the next generation will do what the next generation does. And so therefore, sustainability really isn't as key when employee ownership is really viewed primarily as a financial structure. And in essence, employee ownership in those companies takes on, the sort of the rhythms and ideas of private equity investments, where the goal is to hold it for a while and increase the value, not to see employee ownership per se as a value and as important for the long run. But, of course, we do have a bunch of employee-owned companies who see it not only as a financial fact, but as a moral fact and as a key competitive advantage. They view themselves as being more successful because they are employee-owned for a variety of reasons. And they also see it as an inherited legacy from either prior employee owners or from founders who really made some sacrifices or did some things to make this happen. And from their point of view, and from the point of view of a lot of folks, the idea of sustainability is important because it maintains particularly good jobs and local capital investment in a particular environment. Employee-owned companies don't pick up and move to China as fast. They are a little bit slower to do things that are bad for communities and bad for employees. And of course, where there is a high labor value to what the company does, it also may be critical to the long-term company's success. It really may be that employee ownership matters a lot to how the company business plan works. And then particularly we run into a lot of mission-based businesses, companies that care not only about making money but about what they do, and where the alternate ownership structures might not continue the mission focus. And a good example of an Ohio company, one that's actually fairly near the center, is a company called Prentke-Romich, which makes devices that allow disabled people to communicate. And these are primarily used by kids with cerebral palsy and stroke victims and the like who need boards and manually operated communication devices. And there are a few large companies, companies that are sort of in that business, but they really don't have the particular commitment to the community and to the need. And the founders there thought it was very important that this company be employee-owned as an alternate ownership structure to preserve the mission and preserve what they were doing. And finally, in the long run, sustainability planning, which is planning for the long term, may be the thing that actually creates the most value for folks who own a company, whether it's a matter of ideology remaining employee-owned, sometimes just doing the actual things that focus on the long term are the best things to create long-term value. So what are some of the key positive factors we see? What makes companies continue successfully as employee-owned companies for the long run? My short list of things, again, some of which we can control and some of which we can't. The ones we can control is it's great to be in a stable, profitable business. If you have a business that grows a little bit every year, makes money every year, makes a little bit more money over the long run, those companies are really well suited for employee ownership. If they, if they're growing very fast, they become attractive to other suitors. If they're not doing well from a business point of view, they have problems just succeeding over the long term as an independent company. So stable, profitable business is probably the first and most important factor, and it's a controllable factor, but certainly not by your employee ownership advisors. That's something that goes to the company and its business plan and the business that it's in. The second, of course, for any business succeeding over the long run is the high adaptability to changing business circumstances. Don't really know any companies that are doing exactly the same things, making exactly the same products in exactly the same way, as they did 20 years ago. So you have to adapt as markets change, things change, and so forth. And again, this isn't particularly related to employee ownership, but it does matter for the long-term sustainability of a company. And then we get into some of the particular things that matter to employee-owned companies, which is, first of all, a key positive factor in sustainability, as I put it, would be sort of employee ownership in the company DNA, which is to say people in the company believe and expect that the company ought to be employee-owned. They view that as the key fact about the company and the key fact about the culture, and in fact don't really even imagine what it would be like not to be an employee-owned company. So so the first thing we look for in sustainability are the strong belief that this is who the company is. The second thing we look for that we can affect is good long-term planning around liquidity and succession. And liquidity, of course, is really in an ESOP company about repurchase obligations, which we'll talk about in a few minutes. But succession is, the challenge for a lot of companies is, first of all, to get beyond the generation of the founder and get to the point where we have managers that have and executives that have come to the company from somewhere else or grown up in the company as a sort of second-generation management team. But the perpetual task of every management team is to replace themselves. And that's a key fact, certainly, in sustainability, because companies that don't have stable executive management are not going to do well generally, probably, and are certainly going to particularly have a hard time remaining employee-owned. And finally, we think that good governance and organizational culture practices matter a lot, too. Companies, there's some data out there, certainly, that suggests generally for both employee-owned and non-employee-owned companies that good governance practices correlate well with long-term business success. And again, the more that we do that to run a company well, the more we've enhanced our ability to remain independent and remain independent as an employee-owned company. So now I'm going to talk about some of the key issues here and walk through a little bit about how we work and think about them and how they relate to sustainability as we're talking about it here. And first and foremost, we did last summer with the ESOP Association a sustainability conference, and it's not coincidence that the sustainability conference that was done was the outgrowth of a long-running conference entitled a Repurchase Obligation Conference, because liquidity for employee owners is the absolute key issue, and repurchase obligation is, in fact, one of the key issues for any company that wants to remain independent, remain employee-owned for the long term. Because if you can't provide liquidity for your shareholders, then you're going to need somebody else's money at some point, and the need for other people's money is the key trigger to needing to sell the company to somebody else. And of course, repurchase obligation is the legal obligation that's imposed upon ESOP companies to provide cash to participants who are entitled to receive a distribution from the plan. And unlike, there's some good and bad news about repurchase obligations relative to the traditional kinds of buy-sell obligations that might occur if several of us owned a company independently. And so if Chris and I and two other folks formed and invested in a company, and we wanted to remain independent, we'd all want liquidity. We'd have a buy-sell agreement, and at some point one of us would want to leave or would leave according to the terms of the agreement, and the others would have to pay out. And that would be the normal process. And in a lot of ways, repurchase obligations resemble that kind of buy-sell process with a couple of key differences. First of all, we have a lot of employees rather than only a couple of owners. And so rather than having a couple of major events when one of the key shareholders leaves, we have lots of nicks and cuts. It's a recurring obligation. It's one that really occurs for most long-term ESOP companies in some piece almost every year, if not every year. And at the same time, the second thing that is that unlike a agreement among a few people where we could modify it easily, or we could say, boy, this is not the year we want to delay payment, we want to negotiate terms, repurchase obligations are fixed by the terms of the plan and by the law. So we can't simply say, gee, we had a 5-year payout in the plan, can we pay you out over 7 because times are a little tough, we'll pay you a little more interest. That's not a discussion you can have in an ESOP company. You're, if you will, rule-bound on how you're going to deal with liquidity, which is repurchase obligations. And so obviously one of the things we're going to talk about is that if we're going to be rule-bound and we have at least some initial flexibility to design the rules, let's be smart about designing those rules. And of course, this continuing liquidity requirement managed badly can create a lot of financial stress, and that's what impairs sustainability. And if you look at ESOP companies that get sold, it's often cited, by the way, not always correctly in my view, but it's often cited as a reason why companies that are employee-owned get sold to non-employee-owned environments.
Jim?
Yeah?
A quick question. You just mentioned you don't think it's always cited correctly. Do you get the sense that a lot of employee-owned companies tend to fear it to a greater extent than maybe they should, and that causes them to do something that they perhaps might not want to do? If that makes sense.
Yeah, I think there's a little bit of fear out there. I mean, the survey data doesn't suggest it's the primary cause. It's often a contributing cause. I think it's very much sort of the secondary disease when there's a primary disease that is impairing a company rather than the primary cause itself. You really don't hear about successful, profitable companies doing well all of a sudden feeling like we got to sell because we got no other way to provide liquidity. What you hear about are companies that are going through all sorts of other issues and problems and then fearing either realistically or unrealistically the repurchase obligation as an additional contributing factor, if you will.
Okay, thank you.
And by the way, I'd also add to that, just as a parenthetical, I think sometimes, we'll talk about this in a little bit, I really do want to, I think it's one of the things that doesn't get focused on, is a lot of times the executive teams in companies where they have a lot of wealth between the ESOP and perhaps some outside plans really get fearful that the liquidity for them won't be there. And so it's a fear of repurchase obligations, but not for the whole company, but really for their own particular purposes that can often drive the key people in a company to say, gee, let's sell it and I can cash out and diversify. Anyway, repurchase obligations, of course, occur as a result of distributions from the ESOP, and the primary cause of repurchase obligation is termination of employment, either because people leave or because of death, disability, and retirement, exercise of diversification rights, and sometimes we have in-service distributions. And of course, the basic rules under the code tell us in general that the longest period we can pay people out after they leave for the value of their accrued benefit in the ESOP is either over a 5-year period beginning 1 year after death, disability, or retirement at a normal retirement age, or over a 5-year period beginning 5 years after termination for other reasons. And so these are the maximum periods we can draft our ESOP plans to provide for distributions, and of course some or a lot of companies do this over a shorter period. And if we look at the factors that affect it, and and I call repurchase obligation a manageable variable because there are things we can do to affect both when and how we pay people. The when, of course, is affected by the ESOP distribution policy, how we draft our plan or how we draft our policies under the plan. The when is, of course, also affected by employee demographics, and the amount that we pay, of course, is affected by how we build up stock balances, how many shares people have in their accounts, and probably equally or more importantly, what those shares are worth. So let's talk a little bit about how we can proactively do things that affect those values. And the first thing that we would tell you, that I would tell people, is to design plans to delay and spread obligations over as long a period of time as possible. In other words, a lot of companies say, gee, we want to pay retirees out in a lump sum. We don't really want people who have left the company to continue to have the risk or benefit of ownership of the company. Or, gee, we want to pay other people. And I've walked into loads of companies, now mostly older employee-owned companies, where you have a company that says, well, you leave, you get a check in about 3 weeks. And that work is great, if you will, in the normal environment where you have people leaving with not too large account balances and you've done a little bit of funding and you've a stable, profitable company. And so people think, well, gee, it's always worked for us. And the problem is one of those things that works great until it doesn't, which is to say if the company has financial distress, if the company has liquidity issues, even as a result of growth, it finds itself all of a sudden it's very hard to cut a check when people leave, and gee, we have a layoff, and now we have, a good percentage, some percentage of our workforce left, and they all want to be paid right away. And so there's some pretty notable employee-owned companies, I think, that have had some pretty bad designs over the years in their plans, and that in itself, and so you can say repurchase obligation was the cause of death, but in fact, some of the wounds were self-inflicted. And again, I think a good example of it, a company that had some other business challenges, Lord knows, but in Ohio, certainly by the published reports, Antioch was a great long-term employee-owned company that reflected the values of its founders, but with a very poorly designed distribution policy. And so as they experienced a downturn and laid people off, the effects were greatly accelerated by the fact that those folks all wanted and needed to get distributions from the ESOP at the same time. The second thing we see is a transaction design issue in terms of how to keep as an employee-owned company, which is we see a lot of design, particularly in the current environment where there's a lot of odd structures around redemptions and internal loans and who's buying what from whom. One of the things we see as a hallmark of good design is to allocate the stock that in the ownership that the ESOP is going to get over a good long time. It doesn't really make sense in our view for 100% of the stock of an employee-owned company to be allocated to employees over a 2, 3, 4, 5-year period, and yet we see a lot of designs and a lot of funding policies for ESOPs that do that. And of course, what are we doing? We're paying people a very high level of benefit and then saying, hey folks, that's all there is. But what have we done? We've created a lot of ownership that needs a lot of liquidity in the short run rather than having what I would view as a more sensible scheme of allocating stock over a 10 to 20-year period for the long run. Now obviously the particulars depend on the value of the stock, the nature of the workforce, the particulars of the transaction, but I'd start with a bias in favor of allocating the stock over a longer period of time rather than a shorter period of time whenever possible. And by the way, even if you've done your transaction and you sort of hit that point where all the stock is allocated, there are again some tools to look at, whether it be selling new stock to the ESOP, newly issued stock, contributing newly issued stock, or doing some other things that really start the cycle over again and allocate the stock over a longer period of time rather than being in a fully allocated position all the time. Any particular questions on this? Third thing that we see is managing repurchase obligations for sustainability goes to the valuation. And one of the things we see is obviously there's a lot of different practices out there from the point of view of valuing the stock in employee-owned companies. But a couple of things that one can do to stabilize valuations is to develop better business forecasting models. If your appraisal firm is coming in each year and giving you a valuation based on last year's results or a rolling average of the last 3 years, your valuation is going to be extraordinarily sensitive to current market conditions. You have one good year, your valuation shoots up. You have a bad year, your valuation shoots down. You have a little bit of a yo-yoing effect because it's really not looking at the company from the long-term point of view that a long-term investor ought to have, be it an ESOP or anybody else. And of course, the only way we can take a long-term view of the value of a company is if we've got good forecasting models that say, in a normalized way, here's how the company is going to do over the long run. Now, of course, any projections we do are going to be, as we like to say, precisely wrong. But on the other hand, the longer we project out and the more normalized view we take of projections, the more likely the valuation of the company is going to remain relatively more stable through the downturns and upturns of the economy. And more stable valuations, in our view, make for greater sustainability. A company can do better business planning around repurchase obligations and can do better funding policies because they become a little bit more predictable. Second thing is there's an emerging debate, and there's a variety of particular views to be had, but probably repurchase obligations ought to be accounted for in some way, shape, or form in the valuation. Now, the argument against, including them on a dollar-for-dollar basis, of course, has been, gee, it's like a buy-sell agreement. We don't include buy-sell agreements, for liquidity among shareholders when we value companies from the outside. But on the other hand, if the company's going to have a continuous policy of funding an employee benefit plan, we really ought to be looking at that funding as a business expense and as part of the cost of doing business. And of course, the inclusion of repurchase obligations will tend to tamp down a little bit the valuation of the company. And, if I was sitting running an employee-owned company and saying, how do I want to value the company knowing I've got repurchase obligations? Obviously, the temptations a lot of folks have is, let's figure out the lowest value we can get away with on the theory that makes, it's anti-dilutive to buy back stock and my stock gets more valuable. But from a fairness point of view, I do think conservative valuations, not ridiculously low valuations, are good for sustainability. It creates predictability and it reduces the cash drain on the company. And of course, finally, the key thing to managing repurchase obligation for sustainability is to have some idea of how one is going to fund it. And, there are companies that can plausibly and appropriately do pay-as-you-go funding, but for a lot of companies, they really ought to be doing a mixture of some good repurchase obligation projections and some good planning around repurchase obligation funding. And of course, projections are typically done. There's a couple of folks and companies out there that specialize in the projection side of the world and sort of analyzing things and coming up with funding strategies. And this, in my view, is a great place to use good outside experts. Like everybody else, I probably have some opinion as to who's more expert than others, but it really is useful to be talking to some of the folks who have really been doing this for a long time and have done these kinds of projections regularly.
Jim?
Yeah?
Do you have a sense of, if you had to, give a 30-second version, what are some of the key ways to fund for this? Because generally when you're talking about, let's say, a buy-sell agreement is through insurance.
Well, my personal viewpoint, which I share widely, is I think very poorly of insurance funding strategies in employee-owned companies, particularly now that most employee-owned companies are S corporations, because the whole idea of insurance funding is you're putting money away that will presumably accumulate and grow tax-free. And by God, if we're an employee-owned S corporation, 100% ESOP owned, we already can put money away tax-free. We don't need the insurance product to do that. And so I'm not seeing insurance products as particularly useful in that environment. There is some use for insurance, I'll mention, by the way, which is doing modest amounts of term insurance on folks who have large account balances.
Okay.
Which doesn't cost the company very much, but gives the company the ability to quickly fund a death benefit. That makes all the sense in the world to me. If I had a policy that said every time I've got an account balance north of $50,000 or $100,000, I'm going to buy some term insurance to deal with a death benefit there, that one you could convince me about all day. But in terms of funding mechanisms, key funding mechanisms to me are putting money away, and basically putting money either in a sinking fund in the company or putting money away at in the plan itself. And there's reasons why one might do either of those. But trying to figure out a normalized level of funding so that when the lumpy big years happen, there's some money accumulated from the years in which we didn't have to fund it so much.
Right. Okay. Makes sense. Thank you.
Going along here. One of the things I think doesn't get paid attention to enough in this environment, and something I've just really frankly started to think about in the last year or two, having seen some situations that involve this, is not only dealing with repurchase obligation issues around funding issues, but also really paying some more attention to the succession and executive compensation planning issues. And the reason I say this is that if you look at the typical 100% ESOP employee-owned company that we might see, there's almost always in there some significant executive compensation plan, setting aside, 5, 10, 15, 20% or even more of the ultimate value of the company for the benefit of key management. And I would say that the reflexive thing that most folks do is you tie that benefit to the stock value, which is good because it aligns the interests of the shareholders with the interests of executives. But one of the things we do then typically is we don't always think about those plans as being another form of repurchase obligation. And if I'm doing a repurchase obligation study or analysis, I think I want to include the money I'm going to have to pay to key executives when they leave outside of the ESOP, as well as what I've got to pay them out in their ESOP accumulated benefit. But one of the things we also really do reflexively is, in essence, we provide a reward to a lot of these executives if they choose to put the company in play and sell it. And particularly what we see in virtually every plan is that there's a benefit payable to the executive upon a change of control of the company. And upon a change of control, they get paid out in full their accumulated stock appreciation rights or phantom stock or whatever we've given them. And so what we've done is we've really embedded, if you will, a bit of an incentive for the executives and employee-owned companies to look at a sale of the company, even if it's not for much of a premium, on the theory that it really can create instant liquidity and a significant level of wealth for key people. And I really have a perspective at this point that says we really ought to be looking at that differently and more carefully rather than automatically assuming that because the outside world does that, we ought to do that. And the reason is that, a lot of these plans are set up, if you will, so that they mimic what private equity companies do, but remembering what private equity investors have is a 5 to 7 year horizon. And if we have a longer horizon than that, we ought to be thinking about how to reward our key executives to make the company sustainable and to keep employee ownership rather than rewarding them upon a change of control and selling it to a non-employee owned investor. Curious if there are any comments on this. And so the other thing we ought to do is...
real quick, sorry, I think that's a good point to remind folks. I've been sending a chat message out, but if you have any questions as we go along, you can press *7 to unmute your phone, to open up your particular phone line and then ask a question that way. You can also send a chat message on the lower left-hand part of your screen, and you can also hit the raise your hand button, and then we can see that you have a question, and we can break in and have that question asked. So sorry about that, Jim. I just wanted to add in there.
But I would also really say it'd be a great idea for people in designing executive compensation, not only to make sure we don't reward the wrong things, but to think about how to reward the right things and how to reward good succession planning, because that's a hard thing to get people to do, and it's a hard thing to get executives to think about, And if I were, if I were trying to reward people in an employee-owned company, that's one of the metrics I think I'd want to use in terms of looking at executive compensation. Next thing, and again, I'm going to try and be a little bit provocative here, is looking at good governance and organizational culture practices, because I think these things matter. And particularly in long-term employee-owned companies, particularly 100% ESOP companies, I'm really a large advocate of pass-through voting. And the reason I'm an advocate of that is not because I think people ought to be able to elect, Joe from the loading dock every year to the board of directors, but because the more we mimic the processes of governance that are considered to be good governance practices, the more we'll create people's buy-in and view that they have a long-term stake and say in the company. And so I have a lot of companies that run where the board is nominated by a nominating committee. There, if you will, is a slate that people get to vote on individually up or down, and the employee owners do not have the power of nomination, but they have the power of approval, for instance, of directors. And related to that is, making sure that people have some say, feel like they have some say in the long term of the company. Because again, my belief is the more that a company's employees see themselves as employee owners and see themselves as involved and participating, the better chance we've got at having a lot of internal cultural pressure, if you will, to remain independent and employee-owned, and that to me is a key part of sustainability and discouraging, key people from saying, gee, let's just sell the company. Second thing I see as important is mandating in bylaws or other documents having some level of outside directors in the company, particularly outside directors that have some expertise and commitment in and around employee ownership. Because again, I think that the more pollination there is around this, and the more outside view there is, the more validation there is, and the more again it becomes part of the company's culture and DNA to be employee owned. Of course, the easy and obvious ones are to have regular internal messaging around employee ownership and to be more participative, open book management. Of course, these are all of the things that have some correlation to company performance and gaining the benefits of being an employee-owned company, but they also have a correlation to the company having an identity as an employee-owned company as well. And so those are things that I would be looking at. Again, I don't think any one of them is the sine qua non of the whole process, but the more things we do to think, feel, and act like an employee-owned company, I think the more we create long-term sustainability through the governance and organizational culture, as well as the financial structure, plan design, and other things. And finally, and we're running a little bit ahead here, we have some other things that we can do. And I'm often asked by various people, be it boards, founders, key executives, or whatever, how can we ensure that the company can't be sold? And very often I'll talk to a founder who says, I'm selling to the ESOP, I'm taking a little bit of a discount, but I want to make sure the company can't be flipped or sold to anybody else. And I want to make sure it never can, it always will remain independent and never can be sold. And of course, my answer quickly to that is, you can do some of that, you can't do that forever. You really can't control companies from the grave or permanently, but you can do some things over the short and medium term to make it less likely that a company will be sold to somebody else. And of course, the first thing you can do is make sure that the sale price is reasonable, sustainable, financeable, and fundable, so that we don't create economic distress in the company simply by the structure of the initial buyout. But the second thing is we've looked at a whole bunch of ways that are particular deal terms that founders and key shareholders can make it a little bit harder or more expensive to sell a company through the transaction plan. And one of the things we've done, for instance, just as an example is, and this goes back to my mission-based company I described earlier, is we created what we called in that transaction non-economic warrants, which was the idea that if the company was sold in the first 10 years of employee ownership, there was a warrant exercisable by the founder that would take away a lot of the gain and proceeds that would otherwise go to the employee owners if the sale was for a premium price. So, the warrant was priced out of the money, but the idea there was to create a significant economic disincentive to people saying, hey, let's sell the company. Second thing we can do is we can build in supermajority pass-through voting requirements for any kind of change of control, so that if we want to sell the stock or the assets of the company in one form or another of a transaction, rather than requiring 50%, or in some states it's, it would be 67%, we can raise that number. Now, you want to be careful here because there are circumstances where you might need to do something. You might need to sell the company. You might need to find a way to do it. But embedding a supermajority vote and perhaps a pass-through vote in all circumstances, including stock sales for employees, certainly is going to make it harder to look at selling the company to somebody else. And again, it's striking a careful balance between not devaluing the company too much by making it impossible to sell under all circumstances, but simply raising the bar some. And the third thing that comes up a whole lot is there's a lot of companies that are concerned, well, people can get access to our valuation. We have a lot of policies where we pay people well. Our valuation may be relatively low, relative to a more rapacious financial investor who would do different things. What do we do if somebody comes in and makes us an offer and says, here's, your fair market value, but now we'll run the company our way. And what we've seen is a lot of boards putting together policies, sometimes ratified by the ESOP or the shareholders, that really say the company generally isn't for sale and raising a pretty high bar before we'll even begin to discuss or negotiate a potential sale with a third party. I've got a letter I use as a sort of a form, which, by the way, if anybody wants it, just ping me and I'll send it, that sort of said that it is sort of we're really not for sale, you have to bring us the witch's broom and then some for us to begin to even have a discussion or negotiation with you. And again, if you open doors a crack, people will come through them. And so one of the ways to discourage third-party sales is to keep the door closed here within reason, obviously within the context of the fiduciary duties of both the board and the trustees. So, folks, that's the formal presentation. I'm happy to take informally any questions. Maybe, Chris, if you want to unmute everybody, if there's anybody that's got any questions or comments before we go, we can take them.
We have a quick question over here. How do these things that you just talked about, these other ideas on creating a sustainability issue, how do those, in what manner do those sometimes conflict with the trustees, with the ESOP trustees' mandate to act on best half of the members of the ESOP? Do you find that those conflict a lot, a little, not so much?
Well, the devil is all in the details, but taking them in particular order, the first one, which is how do we build some disincentives built by the founder. Normally, the founder who wants to do that because they've sold at what they consider to be a bit of a discount to what a third-party buyer might pay. And so from the trustee and the appraiser point of view, they're buying the company subject to this restriction, which is akin to a sort of a marketability limitation, but it's reflected in the deal terms to begin with. So properly structured, some of those things can be built in, which you can't have as a fully and excessively priced sale and then a whole bunch of other constraints. On the board policy side, again, it's a question of how carefully you craft the letter. If a board basically says, we think we're better off remaining independent than employee-owned, yes, we know from a fiduciary point of view, we've got to listen if we're blown away by an offer, but we're not going to simply, answer every letter that comes in over the transom saying, we've got a buyer for cash who wants to buy you. What you're trying to do is slant the table a little bit, not turn it over, in my view. And trustees generally, and sometimes you can ask trustees for ratifications of these, are comfortable if the goal is long-term benefit for employees.
Okay, that makes sense. I think I'm going to do what Jim said. I'm going to unmute all the phones, so if anyone's got any large amounts of noise going on in their office, they might want to try and find a way to minimize that. I'm going to go ahead and hit the button here, but I'm going to take this opportunity to just kind of...
The conference has been unmuted.
Just open up the floor for questions. Also, at some point, we're going to stop the recording of the session. So if anyone has any questions that they don't want to be included in the recording, kind of want them to be off the record, so to speak, we'll have an opportunity to do that now. But the floor is open. Do we have any questions out there?
I don't have any questions, but Jim, this was a very insightful presentation. I thought this was extremely well done.
Thank you.
So, no questions? Well, I guess that's a sign that you covered everything well and in a non-confusing manner, I guess, Jim. We can say.
All right, that everybody can wake up now.
Right. I'll go with the former. So I want to thank Jim. Let me put up a slide here with his contact information. We've known Jim for a lot of years, and he's one of the experts in the field. And we really encourage folks, if you have questions, to give Jim a call, contact him. You can send the email address there. What I'm going to do now is I'm going to unrecord the session so we can open up the floor for any private questions that we might have.